All right. So this class is going to focus on a topic that me and mentor of your mentor, or Leslie, were talking about, and it's been a topic that Wyatt has been putting a lot of emphasis on, and I feel like it's time for us to address it in the chat. We've never really addressed it. It's been something that's kind of been kept under wraps, and there's a reason for it. It's a reason that a lot of you guys have been trained by retail traders. A lot of you guys have been trained by people who use kind of, the same systems as everybody else. And that's okay. You guys, really didn't really know better at that point. But now you guys are going to start knowing better, right? And that's something, that's the point that we want to get you guys to. Now, a lot of you guys have been asking, right? How do you know where banks actually trade? How do you guys know where banks are going to go? If you guys don't have access to this type of thing. And let me put it very, very plainly for you guys. Banks don't care about you. Okay, they don't care about you and your $100 account. They could care less if you blow it or if you flip it to 1,000, because they're dealing in the millions. They're dealing in the billions. They're dealing in the most massive numbers that you guys wouldn't even wrap your heads around, right? Now, when it comes to trading, there's a couple things that you guys need to know. First off, and I'm going to go ahead and pull out the whiteboard here because a lot of you guys
Hey, man.
seem to really, really like the whiteboard. So make sure you guys mute yourselves whenever you guys come in here. And if
Hey,
you guys,
man.
hey Adam, and whenever you guys want to unmute yourselves, whenever you guys have a question, just go ahead and make sure you raise your hand on Zoom, and I'll call on you once I'm done talking. All right. So here's one thing, right? I'm gonna go ahead and tell you guys how it works, right? First off, you need a foundation. What moves the markets? As you guys know, there's the centralized banks, right? So I'm going to teach it how somebody taught it to me. And it's essentially going to be a pyramid of, of ranks. So it's going to be a caste system. If you guys would remember that term, caste system, right? At the bottom, at the very, very bottom, are you guys. You guys are retail. You make up a big majority, but you guys also make up a low number of volume. What does that mean? There's a lot of you, but you don't make up a large number of the money in the market, right? So even if all retail traders in the world put the same position, it wouldn't really move the market all that much. I would move it, but it wouldn't move that market all that much. So we're gonna put R for retail, right? Next, what do you guys think comes up next? Well, next comes up the smaller hedge funds, right? That comes up, like the smaller banks, stuff like that. Those guys, these hedge funds are really just retail traders with a lot of capital, or investors, right? They've been certified by the financial board, and they have a license to go ahead and trade for you, right? Those are the only guys that you should really be putting your money into. Now, these hedge funds, let's go ahead and put hedge funds, smaller banks type stuff, right? The next comes up the smaller banks, right? Smaller banks. Why do you guys think these smaller banks actually have an influence in the market? Well, the answer is very simple. These small banks have influence in the market because, unlike all of us, banks have to have a certain threshold of money to actually become a bank. They have to have something called standing liquidity. Liquidity is essentially just money, okay? So you're going to hear the term liquidity a lot. Liquidity is simply the amount of money you have in your hand and you can spend, okay? So, or that you can grab as well, right? That you can use essentially. These smaller banks have so much capital that they completely outdo hedge funds and they completely outdo retail traders. Okay. Now above them comes up the larger banks, because there are three tiers to banks, right? The smaller banks, brokers as well, / brokers, right? Because brokers move the market as well. Brokers. And now we have the bigger banks, right? Bigger banks. The big banks, right? Above this, there's one more tier. There's actually two. Well, actually, no, there is one, and then there's one outside. So there's the big banks, right? Because they have more capital than smaller banks and brokers, right? These big banks actually run the smaller banks and the brokers, right? These are subsidiaries of these big banks. Some may come to mind as Bank of America, Wells Fargo, stuff like that. Now above them, what do you guys think lies up here? And there's a time that you guys can actually talk and come up with your answers. What do you guys think comes up here? Let me see. How can go ahead?
The central banks, or like Chase Bank, those guys.
Right, exactly. So these, so there are, the top banks. So
Yeah,
there's a
central
list of
banks.
about, exactly, right, those central banks, those ones that kind of run everything else. So some may come to mind as Chase, Citi, right? A couple other ones, Mitsubishi, a couple, the Bank of China, right? That have in the higher echelon billions of dollars, right? Under their
Like
care.
JP Morgan, right?
JP Morgan is Chase. Yeah, so JP Morgan Chase. So we have the centralized banks. And now there is a difference between centralized and big, right? There is a difference between centralized and big, because all big banks have kind of that threshold between small banks / broker to the capital that they're in the millions, right? So they can deal in the millions. But these centralized banks can deal in the billions. Some even go into, the larger numbers when they're dealing with large deals. Now, we have all these, but the market still remains a separate entity. You have to realize that they can move the market because the amount of money they have, liquidity that they have, right? You can't move the market if you're simply sitting there, right? You have to be actively engaging in the market. However, even if these guys, like, even say hedge funds got taken out, or small banks got taken out, the market would continue, right? Because essentially these guys are the guys playing the market back and forth with themselves. They're playing ping pong with themselves, with the market making more and more and more money, right? And I'll explain to you why in a second. So we see that these guys are players in the market, but again, they're players in the market. They are not the game itself. What runs all of these, like the evil little face in the back, is, what do you guys think this is? Go ahead.
Isn't it like the algorithm? Like
Exactly.
It's some computer.
Exactly. So it's not exactly a computer, but it's basically price theory, right? It's how price actually moves. So if you guys have studied price theory in the past, if you guys come from a financial background, you would understand that basically the laws of supply and demand and what is it called, intergovernment finance, right, or intercontinental finance, interstate finance, right? What they have to do is they basically follow a pattern of price. So essentially, they have to have a certain amount of money ready at all times. So the market in itself moves in an oscillation, which is also known as market phases. And these market phases will become evident to you as you practice. But this market algorithm is essentially what the central banks, the big banks, the small banks, all of us here, that is the game we play. We play with the algorithm. The centralized banks, what they do is they abuse that algorithm. They know exactly where it's going to go, and they know what kind of money they have to place into the market for it to go in that position, and for them to maximize profit in that position. Okay, and I'm about to go into some examples, so don't leave. So does everybody understand this? Does everybody understand these positions?
Yeah.
Cool.
Yeah.
Let's go ahead and let's go to this example. Now, a lot of you guys have been asking us, what is Wykoff? What is, all these complex terms like liquidity grab, like OB, right? Like OTE, like all these different stuff. Like, what is that, right? And the thing is that you can't simply pinpoint Wykoff to one thing and then just go with it. You have to understand it from a fundamental standpoint. So first off, who was Richard D Wykoff? Essentially, he was a stock trader, right? That was under the mentorship of the big players, right? He was alive during the time of Jesse Livermore, of all these giant players in the market that basically founded the market as we know it now, right? And essentially what he looked at was he looked at form data. And then he would look at the actual chart that he would see, and he realized that the market moved in phases, right? And when this market moved in phases, he derived a couple of different positions in which he said, right, in his theory, he said that price will have to meet these conditions, right, these phases, for it to actually move in a certain direction. And those are known as accumulation and distribution, right? Those will be known as accumulation and distribution. So what is this? Essentially, if you go to Google and you look up Wykoff schematics, it'll be very, very easy to find them. We've never kept this a secret from you guys. We've always shown you guys. These this link right here. If you guys want to read up a little bit, this is very surface level information, but it's very good for you guys to to look at this. Now, a lot of people will say, hey, this was created for stocks, and although that's true, this was created for stocks, the market still moves in the same way, right? So let's look at this from from this standpoint, right? Accumulation. Whenever you guys hear accumulation, all this means is a buy, right? A setup for a buy. That's really all this means, a setup for a buy. Now, there are two different accumulation schematics. There's this one right here, right? Which essentially is characterized by a couple different differentiable things. So as you can see right here, there's a secondary test, right? And then there's a spring. Back here, I believe you don't have a spring. No, you only have a secondary test, right? So the test isn't always absolutely necessary. And here's a distribution example. Let's see if I can pull it up. Oh boy. I think I have to. Can you guys see this picture?
Yeah.
Y'all can see the picture that I pulled up?
Yeah, I can see it.
All
Yeah.
right. Cool. So let's look at this example that Wyatt put up, and thank you, Wyatt, for putting up this example. Essentially, right, don't worry about these these little
I can't see it.
things right here. Y'all can see it? Yeah, let me see if I can pull it up. You'll see it there?
Yeah,
Yeah, there we go. There we go.
Okay. So first off, when you guys are looking at this, right, there's a couple things that you guys need to realize about Wykoff. Whenever you guys are looking at a Wykoff schematic, they usually happen during consolidation, right? So during a top, during a bottom, these schematics really only mostly happen during consolidation. Why do they happen during consolidation? Because during this time, banks can engage in in something that I'm going to explain in just 1 second, and I'm going to prove why Wykoff's theory is correct. Okay. Now, you guys will see all of these little numbers and these little, sorry, not numbers, all these little abbreviations, and all of those can be found right here. All of those can be found right here. Where is it? Right here, right? All these really means is, preliminary support, selling climax, and all of these can be inverted to basically the same thing. So if it's, preliminary support, selling climax, and distribution, which is the next thing that I'm going to show, distribution is essentially the same thing, just inverted and backward, right? And it basically means a sell, right? So it still has preliminary support, but now instead, supply, not support, preliminary supply. Instead of a selling climax, there is a buying climax. And instead of the automatic rally being up here, right? Because once it stopped buying, it came back up. Sorry, once it stopped, yeah. Let's go back up and so I can show you guys. So once it stopped selling, right, it automatically rallied up here, right? So instead of it going up in this case, it goes down in the other case. So as soon as it stops buying, it creates this rally, right? And now we have the secondary test right down here. Just whenever you guys are studying this, you guys can just look at it and say, okay, this is a secondary test. And now we have a sign of weakness. A sign of weakness in Wyckofian logic is essentially this. A sign of weakness is simply the banks testing that certain zone and making sure that price can go below that zone. And if it can go below that zone, then essentially they're saying, okay, that, you know, the banks that are trying to go in the downward direction, they're going to start stacking entries, right? So what are they going to do? Essentially, they know that price can now break this zone. So they're going to put some entries into drawdown.
Where's the trend line?
What?
Is it a trend line, or you don't use trend line when you do Wykoff?
I don't use trend lines when I do Wyckoff.
Oh, okay, thanks.
So so what I'm basically showing here, right? Whenever you guys are seeing the sign of weakness, I'm going to show you a quick little example of what banks do to actually move price. And let me bring it up here. I didn't know you could have pictures, but here we go. So essentially, say the bank goes up in this position, right? So they're going back up into this position. Now price is currently in this position, right? And their target, say, you know, there's like another zone right here of liquidity that needs to be taken out. And their target is down here. Their target is down here. If you guys know, well, obviously you guys, some of you guys may not know. So I'll teach you guys right now. The price theory of supply and demand essentially shows this. So for you to sell price, there must be buyers. If there are no buyers in the market, effectively, the market will crash, right? Because if there are no buyers, that means price plummets, right? That means basically this correlation, this pair becomes worthless, right? Because one pair literally just dropped off the earth, okay? So for every sell, there has to be a certain number of buyers. Obviously, if you're trying to move price down, you will have more sellers than buyers. But effectively, by the law of supply and demand and financial equilibrium, right, every time that you have supply and you have demand, right, what you need is you need both of them to cross an equilibrium, right? You need all of them to cross an equilibrium. So the more supply that you have, the more demand that you have until you meet this financial equilibrium right here, right? That's essentially how a supply and demand chart works. Now, the exact same thing happens in the market. How does this happen in the market? Very simply. Banks, bigger banks, have to go into drawdown with some of their entries for there to be buyers and for them to effectively not crash the market, because they're about to go millions of dollars heavy into the market. And if they don't put entries into drawdown, what's effectively going to happen is the market's going to crash. So let's say the banks come in and they put an entry right here for a buy, right, at 100 million, right? Let's say they put it at 100 million. Now, these are similar numbers to what actual banks would use. Now, price starts moving upward. Price creates a double top, right? Then creates, what is this? The buying climax, the automatic rally, the sign of weakness, right? And now we have the upthrust. We have that upthrust, comes back down, another upthrust. Now here, they're essentially stacking certain entries, right? A lot of buyers, you know, retail buyers are hitting their TPs. Some swing buyers are hitting their TPs again, right? And that's fine. That's completely fine. But they don't really care because the algorithm is moving price here, right? So what's happening is they're saying, okay, we're going into drawdown. So now we should see this upthrust after distribution. And now we're going to see all this. People are going to try to buy this double bottom, right? What happens? Their stop losses just got taken out. Cool, that's fine. That becomes another sell entry for banks. But here they entered again at, say, 200 million. There's a reason why they did that. Because right here, they're going to enter heavy at 700 million. You're going to enter 700 million at, you know, for a sell. Now what happens? Price drops, comes back up again, and now they enter again, right? All of the people that tried to buy this, saying, oh, this is, you know, whatever the hell they may think, or saying, you know, like their magical trend line is right here, it's going to bounce off. Cool, they give them a couple pips. Now, the banks aren't doing this consciously. They're not saying, oh, yes, let's counter retail. No, they're not doing this. They're not doing this consciously. They're not stealing your money consciously. They're just doing it because they have enough liquidity to do so, right? So right here, again, they enter another 700 million. They enter again, boom. Now they take price, right? I'm just going to draw kind of like a straight line down here. It doesn't effectively happen like this. Usually when there's distribution, there'd be another phase of distribution called redistribution, right? And it would drop again. Now their target has been reached. And effectively they entered, a couple other times. Cool, right? That's completely fine. Now let's say their target has now been reached. Cool. That's awesome. Now they just made, for simpleman's terms, right, 1,400 million, right? Now let's say they already made this. They already made this money, right? Plus all of the pips that they cut on the way down with their lot sizes. But they have a big problem. They made money, sure, but do they get to keep all this money at the moment? Do they get to keep all this? You guys can go ahead and talk. Well, raise your hands. Do they get to keep this money that they just made? No, well, not really break even because they went in higher lots right here. But effectively, they're kind of crippled by these entries, right? Because they're in massive drawdown. They're in massive drawdown. Well, they have to hit the resistance zone and bounce. No, banks don't care about resistance zone. That is very, very retail, right? They don't care. There is no such thing as a resistance zone. They hit a zone of liquidity, right, where essentially they are now done with this move, and they have reached their target, right? They have reached the target. We're back here. There was probably a fair value gap, or there was, some other structure of price down here that I'm just using this as an example, right? Another structure of price down here that essentially made price fall back down here, right? Trend lines have already been broken. People are like, okay, well, this is now a zone of, a quote unquote pivot zone for it to go bearish. And when they look for their, third confirmation, they effectively already missed half the move. The 100 million and the 200 million were buys. Yes, correct. I apologize for not, exactly, right. The 100 million, the 200 million were buys to raise the market. Yes, effectively they were. They raised the market all the way up here to stack their entries, right? Effectively right here, they probably stacked another 200 million, another 100 million, right? Whatever the case may be, to push the price down violently. Because now price falls violently, right? And right here, I'm using this as, a little bit of an example, but in my experience, what happens here is price will most likely come back and retest this zone right here, right? And a lot of retail will say, oh, my trend line got hit, right? Or a lot of retail will say like, oh, this, will hit. They'll make some type of excuse for price to go up. And price will most likely come back up here and they'll stack more entries. Why? Because a lot of buyers' stop losses right here just became sell entries for the banks, okay? Because a lot of liquidity just got hit there. And if you guys take a quick look at this schematic should seem familiar. This should be distribution, right? In this distribution, you got one entry, possibly, if you're really good at Wykoff, or smart money, you'd be really, really inclined to get an entry somewhere up here, right? And you would get an entry somewhere up here. WWA does that, right? A lot of other companies that are really, really good do it. At the UTAD, yeah. Essentially at the UTAD, that's effectively where they get entries. That's where I've seen a lot of people get entries, and that is where that's where I've seen a lot of my people who taught me how to do Wykoff. That's where they taught me how to get an entry. Now, effectively, you get it right here. Some people get it right here, most don't. The safe place to get your entry would be down here, right? Because you already have the sign of weakness. You're effectively saying, right? You're effectively saying, like Wyatt just said, right? Last point of supply entries are safer. For you guys that are new at this, I would expect you and I would suggest you to please look for those entries more often. Okay, I would effectively look for this. Once you've seen distribution play out and you get this last point of supply, I would rather you go for those last point of supply entries or LPSY entries rather than you trying to snipe the up thrust after distribution. I would rather you do that. Wyatt can probably show you how to get the upthrust after distribution entries. I've gotten some before, but I usually like to wait until I actually see some downward motion. Okay, I just like to play it safer because then I can drop higher lots, right? Now, effectively, back to the bank example, right? These 100 million, these 200 million, you know, to get this upthrust, there was probably, you know, a couple other 100 million dropped. Let's say, you know, like they drop another 300 million right here in buys, right? They drop another 300 million in buys. Now price has reached right here. This is where they start stacking entries, 100 million. They start stacking more and more and more. Now price falls violently, right? Price falls violently. Some of them take partials because, again, the theory of standing liquidity, right? What is standing liquidity? The money that banks need right now, right? So a lot of the banks may run out of money. Maybe, you know, there's a lot of money being spent. Maybe there's a lot of loans going out. You don't know, right? But that's why the last point of supply basically is made, because this is the last point where banks effectively confirm their move, right? So we have effectively 600 million lots in drawdown all the way down here. All the way down here. And these aren't small moves. These aren't small moves. These are thousands of pip moves, right? 100 pip moves. Hundreds of pips moves, sorry, right? What did Lee say? He just said, added confluence as well that price is broken to the downside. Yes, but effectively when you see a distribution or you recognize a distribution schematic, you should immediately assume that price is most likely going to go to the downside, right? That's why I tell you guys to wait for the last point of supply entry. You still have the most of the move left, but it's much, much safer for you guys to enter because, you know, you're effectively getting more than 3/4 of the move. You're just being safe about it, right? After the sign of weakness. And Wyatt adds, after a sign of weakness, or SOS, right here, right? LPSYs are just retracements back up for you to catch entries on the larger move down. Correct. This is effectively what you would look for. Right here, right, it breaks the zone where we're trading at, right, the trading range. It breaks the trading range. And when it breaks it, that is considered a sign of weakness. Now, when it comes up here, boom, right, it starts dropping back again because of the added entries. Now, and distribution schematic is somewhat of a range. Yes, I'll go over Wykoff again in just a minute, but I want you guys to understand bank logic, okay? Here's what this class is intended for. Now, what happens now? We effectively still have 600 million in drawdown. And massive drawdown. I should add, massive drawdown. Because what ends up happening? You have entries right here, right here, right here, that effectively pushed the market up to get banks better entries. However, they know that they have to keep these entries up for the market to not completely collapse. Because if you have 700 million in the bank, I would like to be your friend. You don't have 700 million in the bank, right? You don't have multiple entries of 700 million lots in the bank, okay? You simply don't. These guys with massive capital do. Now, what ends up happening? These 600 million lots in drawdown need to be mitigated. Does everybody know what mitigation means?
No.
If they close at the 700 million sells, won't price pull back up and they can sell at the 600? Now you're catching up. Perfect. Now let's look at this. Let's look at this. Mitigation effectively, if you look it up, effectively means nulling or canceling, right? So effectively, you would be saying it would be the reduction. I just looked it up on the phone. Okay, yeah, here you go. Now, Wyatt just put it up. The action of reducing the severity, seriousness, or painfulness of something. Mitigation, effectively softening a blow, right? Now, banks still need to close break even. I'm sorry, but if you want to close 600 million lots in drawdown, it would be easier, but then the market would crash. Still, the market would still crash because then they close these lots and they take profit here. Now the market's a straight line because there are no buyers and there are no sellers, right? Apart from retail, and that would be an absolute mess. right? So they need to close it back into market equilibrium. Remember the photo that I showed you guys of supply and demand? Market equilibrium is not reached at this moment. The whole game of trading effectively is keeping, maintaining, and returning the market to equilibrium. Okay. Now, let me show you guys something. Leslie makes me laugh. So now, this is the Wykoff you were talking about with liquidity or whatever. Yeah. So this is exactly what we and you were talking about earlier, Leslie, this morning, or last night. I don't remember, but we were talking effectively about how the market, if this is how it works. And now let me show you what happens. The market needs to return to equilibrium. Now the theory of price, right, says that the market needs to maintain or effectively be acting toward market equilibrium. Now, where do you guys think in this graph market equilibrium would be? Where do you guys think market equilibrium would be? You guys can go ahead and unmute yourselves and talk if you guys would like.
Isn't it at the 50% of
At
the
the
whole
trend
move
line. A trend line.
So you're saying at the 50% of this?
of the entire move? Yeah.
Of the entire move? Okay, that's a good answer. All right. At break even, 50% retracement. So some people would say 50% retracement. However, 50% retracement doesn't effectively apply here. And the reason why 50% retracement doesn't completely apply here is effectively because you have way too much to lose here, right? When there's a move of this magnitude, and say we're on the 4-hour chart, when there's a move of this magnitude, you need to know this. No, you need to know this. There is no reason for banks to just take it here and then keep stacking more entries to the bottom. There is none, right? Market equilibrium, according to what I have studied as the market theory of price, would be up here, would be within this range. Not all the way up here, but it would be right here, right? Now, why? Why? Because now, thank you, Wyatt. I'll pull that up in just a moment, right? So now, and no, it's okay. It's okay, Zay. I know. I've heard a lot of people say that equilibrium is at the 50, and effectively it is, but in certain positions, not in this position, right? In this position, banks are going to start looking for what? What is this?
Consolidation.
Is this consolidation from what I just showed you guys? Accumulation. Perfect, Evan. This is known as accumulation, right? Which happens in consolidation, so you were correct, right? But effectively, this accumulation ends up pushing price. No, so it's not banks testing if price can go below. Effectively, it's banks stacking entries over here with their remaining liquidity because they just, they literally closed out a little bit of their lots. So they closed out some lots, but they also put in some more sells here to do the same thing that they did up here, right? And it's more likely for price to get ready to push back up. Now, price pushes back up, but they repeat the same process. They say effectively, okay, but now here's where trends come in, quote unquote, trends come in, right? Price has to retrace to this area to basically effectively meet their target. Now, we know that they're going to mitigate these losses. Close break even, maybe at a slight profit, maybe at a slight loss. That's completely fine. However, to not absolutely shoot the market, what do they need to do?
Create liquidity.
Create liquidity, which means what do they need to do right here? What they do up here? They have to enter for sells. right? They have to enter for sells here, but they don't have to enter for sells at 600 million. They don't. They don't need to enter at 600 million. They can sell to buy again. Perfect, Keenan. They have to sell to buy again. Now, what does this mean? Effectively, this means they're going to enter maybe with 50 million. They're going to enter maybe here with, maybe here's where the 100 million comes in. Maybe here's where, only 25 million. They only want to sell but 25 million. Now, this will be a violent push up to the upside again. And all those sell swing traders, quote unquote, are good. They're going to completely miss this accumulation schematic because they only trade with, fibs. And what they're going to do, they wait to sell to buy again and trigger more people in the market. Perfect. Good, Aisha. So they entered with lower lots here. So what's going to happen if they enter with more buy lots? They throw in a couple million to keep the market at equilibrium, right? And now what's going to happen? Price is going to shoot up violently, right? They close most of their lots up here, or all their lots right here, right? And they open new sell positions at the bottom, right? And now they're buying. So price is buying because they also stacked, a couple entries to the upside. But they also stacked, say, let's say 500 million to the upside. Oh no, that would actually push price lower. Whoops. Let's say they put like 3 entries, right, of 500 million. Let's say they put 3 entries of 500 million. Price is going to explode to the top side, right? And now they're going to reach their target, which is market equilibrium, right back here. Now they can close out these lots at break even, or at a little bit of a win, right? Now this is where trends come in, because effectively, since they put so little sell lots and they put so many buy lots, what is price going to do here? This is where the market makers abuse the algorithm. They know how they can manipulate price. They know how the algorithm is going to respond to their actions. All they need to do is press their button to make the algorithm work for them. Now, what's going to happen? They sell right here with effectively 175 million lots, but they're buying with 500 million lots times 3, right? They're buying with 500 million lots times 3. Now, let's weigh buying pressure versus selling pressure. How many buyers are in the market at this moment? How many buyers are in the market? Effectively, there's 500 million, right, active buyers, plus 100 million, plus these 600 million lots. Okay, so there's a massive amount of buyers in the market right now. How many sellers are there in the market? They've closed out all these lots already for the sells. There's 175 million lots in sells. So price is going to explode here. And it's going to break this target. And it's going to keep going up. And effectively, in the day chart, it's going to look like this. What does this look like? Trend line, right? A lot of people would say trend line, but no, it's not a trend line. This is an uptrend, right? Higher highs, higher lows, higher highs, higher lows. But people that use this don't actually know where it comes from, right? Now we know where it comes from. Now we know this all this market equilibrium, right? But effectively, people that use trend lines are going to miss entries. They're going to over leverage. Their trend lines are going to get broken. Why? Because they don't understand the theory of accumulation and distribution. They also don't understand the theory of, proven theory of liquidity. Liquidity is all this money that's being moved around, right? Does everybody understand this? This shed light to you guys.
Yeah.
Yeah.
Yes.
Does anyone have any questions? Now, let me open the example that Wyatt sent in the chat, which I told him that I would open. Let me see. And make sure you guys thank Wyatt. He's taking time out of his day to help us out. Let me go ahead and share my screen. And let me. Cool. Okay. Let's look at this. Now, where do we get the zones? Okay, so here's one thing that I need you guys to understand. Price is fractal. Okay. What is fractal? Fractal in the mathematical term is basically effectively that it's a weird mathematical formula, but basically it's a number repeating itself. Right? How often is Wykoff? All the time. Wykoff happens at all time frames, at all times. Well, at most times, because the market is a cycle. And I will explain that on another call because I could go hours and hours and hours talking about market cycles. Now, let's look at this example that Wyatt just sent. But before we go into it, I want you guys to take a second and make sure that you guys have all of your notes written. If you guys have any questions, please raise your hand now before I go into the next part of the lesson. Go ahead, DeMarcus. Okay, I think we left him. Go ahead, Ashfakur.
Oh, like what does it take to be like a certified trader? Like for the banks, like besides being good, like.
So you have to go through certain courses. You have to have, I think, a degree in finance or economics or something like that, and then you have to have a lot of a lot of connections. Honestly, some people start through becoming a part of a broker, and then from there make their way back up. Some people just straight up go to a firm in New York, right? So some of them go straight to a firm. I know that Purdue offers a course in Purdue University offers foreign exchange trading as an actual major. Some people go with that. There are many ways. Personally, my next door neighbor is best friends with a broker from Charlotte, right? And he told me, "Hey, I'll hook you up." So maybe I could become a bank trader someday. But effectively, it all comes down to what you study, and it effectively comes down to your connections and your qualifications that you have.
Thank you.
Mm-hmm. So DeMarcus just asked, so is this where you would open 1.0 lots? Your risk to reward has to be worth it. If you want to open, a 1.0 lot, you have to make sure that you have the account size for it. But a lot of times I do find myself slightly over leveraging in LPSY entries or LPS entries, right? Simply because I know that the market's going to do something. But I do like to keep my stops 10, 15 pips, less, 5 pips. I try to go for 5, 3, 4 pips, right, as a stop loss. And that's the only times that I really leverage a little bit higher. All right. Okay. And guys, make sure you guys keep the chat clean. I don't wanna hear anything right now. Class is going on. You guys can talk about this later in the lounge. Okay? No, it's all right. Draw the fib. I'll draw the fib later. So effectively, what we're going to see here is this is an example of accumulation, right? And now what we see with automatic reactions is something that I'll explain to you later, right? This right here is the top of the trading range, and this right here is the top of the bottom of the trading range as well, right? Now the tops and bottoms of a trading range aren't lines; they're zones to me, right? To me, they aren't lines; they're zones. So from here to down here is my zone. So if I would draw a rectangle right there, that would be my trading zone, and from here to up here would be my trading zone. Now, when effectively, I do not see any sign of rejection here, I immediately expect this and say, okay, this is going into a spring, right? Because I effectively do see an accumulation here. What happens? It drops right here. You could be looking for more sell entries. Do you have an order block right there? No, you don't. Okay. So effectively, right, you start stacking more entries to the downside. You get your GP. Cool. Awesome. Amazing. You're doing great right now, right? You have an order block right here. Boom. Your stop loss never gets tapped, and you're riding it all the way down. Cool. You have your TP at your selling climax. Beautiful, right? Now that you're out of the trade, you see that this is actually a spring. You look back and you look at the hour and you say, oh, damn, this is actually accumulation. Awesome. Now what happens? You have this spring, and some people try to get their entries on the spring. Okay, some people can do that. I personally don't like risking it. What I like to do is if I see upward movement after this, some people may say, oh, retracement, enter more sales. And some of them do. And what happens? They get absolutely destroyed, right? They get absolutely destroyed when they try to sell up here, right? Or they try to use their fib and say, oh, the 88.6, oh, the 79. Optimal trade entry. No, because they don't know what they're doing. They're way too zoomed in, right? Now what ends up happening? Once we see this Wykoff schematic and we say, okay, cool, we have this test. And on the test, I would like to see where price returns to. Now, if we zoom in here, what do we see? Where does price return to? Where does the wick to? Where does this candle wick to? Look over here. What does it wick to?
Order block.
Perfect. That last down candle before the move up. Perfect, Ivan. The last down candle. So we have the down candles, the last, right down here, the last down candle, which is right here. The important parts of the down candle are going to be the open and the close, right? The open is where you want to set your limit. Optimal trade entry would be the middle of this candle, right? So you have it right here, this entry, boom, your buy limit gets hit. You have a second buy limit at the middle of the candle, just in case. And your stop loss effectively is at the close of the candle. Some people like to put it beneath the wick. Either one is fine, right? And now your limit gets wicked, zero drawdown, boom, all the way back up. You may miss this by like spread, honestly. But it gets hit, right? It gets triggered and you come back up. Now you have this, the open again, right? The three prominent parts of an order block. The open, the 50%, and the close. Stop loss beneath the close or the wick, right, wherever you want. Or, the stop loss is right there. Entry or buy limits, right, at the open of the candle. And your second buy limit could be with a little bit higher lots or however you'd like to do it, at the 50% of the candle. Now here the 50% doesn't get hit, but in other times the 50% does get hit, right? Now you get wicked and now boom, you fire off. And now it tests again. When it does this and it starts reversing a little bit, don't get hopeful and say, oh, well, I should probably hold. You can take half your lots here. That doesn't like affect you. secure some of your profit. And now when this next last point of supply comes in, or support, right? When it comes in, you can enter again. And what happens? It comes back up to another zone. It comes back up to another zone, right? It fills around 50% of this inefficiency. And then it goes back up. And now what happens? Again, you can re-enter here. What happens? Another blast up. Now you can hold it from here, or you can let it continue going up. Now what happens? Again, it mitigates around 50 to 79% of this move. What happens? You get another entry right here off this wick. Why? Because you effectively know that if the market is moving this inefficiently means that, you know, the banks aren't getting enough entries on this move up, right? And now what happens? Boom, it mitigates around 50% and it fires off again. So effectively, you had 3 to 4 entries on this move. And if you were paying attention to it, you knew exactly where to set your limits. Okay? You knew exactly where to set your limits. You knew that to set your limit right here at this bullish order block. You knew to set your limit at this mitigation zone. And you knew to set your limit again at this other mitigation zone. Right? So effectively, and if you caught this spring shakeout, buy entry, perfect, awesome for you. I wouldn't have. I would have only caught the last 3. Right? And all of these have to have had big reward to small risk, meaning your stop loss no bigger than 15, 20 pips, 25 pips if you're feeling a little bit ballsy, right? Perfect. That is essentially how you trade this. Does this make sense to everybody? And now a lot of people are going to combat this and say, oh, well, you know, Wykoff theory is this, Wykoff theory is that. ICT this, ICT that. And I'm going to put an end to both sides because both of you are right. Wyatt is using both theories here. He's using both theories. Look, he's using order blocks, which effectively were, you know, they weren't thought up by ICT, but they were effectively brought into the light by ICT. Right? He's using them here. Mitigation, which effectively was used by Wykoff to place his theory, right? And is also used by a lot of other institutional traders. RCV visionaries, they use mitigation as well, right? WWA gets entries on the spring. How? I don't know. I just know that they do, right? And they have their own method of doing it. ICT is different from this, obviously. Obviously, ICT is different from this. But effectively, effectively the market moves in a very, very similar fashion, right? Of course it's different because, you know, his way of trading is much different. But when you mix these two things together, you get a much more precise way of trading than if you would just use Wykoff, or if you would just if you would just use Wykoff or just use institutional trading. Because essentially what ICT teaches is liquidity. And you cannot tell me I'm wrong because that is exactly what he teaches, liquidity. And Wykoff is simply watered down liquidity. That is what it is. And that is what I'm going to teach you guys in the academy. That's what Wyatt's going to specialize in. Wyatt has been an amazing help for us. So has Leslie. So has Sean, right? A lot of you guys have been a great help to us, bringing all of this into light. Oh yeah, Reyes, where is he? I want to make sure that he's still in here. Oh yeah, he's still here. I'm pretty sure he's still here. Now, back to what I was actually going to say, right? Price is fractal. What does fractal mean? Like I said, fractal is essentially a number repeating itself, multiplied by itself, repeating itself, right? Now, that's in math, but in price, it means the exact same thing. In price, if we go to say, you know, if we go to the 4 hour and we see this example of distribution right here, and effectively we go to the 30-minute, it's going to show you the exact same thing. These two look very similar, don't they? 30-minute, 4 hour. Very similar. 30-minute, and then the 4 hour that we just saw. They effectively show you the same exact thing. They just show it to you in a different time frame. Now let's go to the 5 minute. Effectively, you're shown the same exact thing. You're shown that, you're shown this up thrust, boom, awesome, perfect. You get this, you get another entry, right? Some people may be like, oh, 5 minute order block. Okay, sure, use the 5 minute order block if you would like. It's not exactly an order block, but price reflects itself. So if price is obviously going to fall, this is where evidence of the, the mythical algorithm is present. Because you know that the algorithm has to keep up a certain pattern of numbers or form data, as you will hear me refer to it, right? Effectively, this zone right here is, I don't like calling it a 5 minute order block, but it effectively is a 5 minute order block, right? Because price reflected itself. So what would your entry have looked at, right? It looked like right here. Would have looked, okay, at the beginning at the open of the candle, boom, your stop loss was 5 pips. And then, say you use your fib extensions, fine, whatever you want, right? You'll just use your fib extensions. And your target will be all the way at the bottom here. Your first TP will be at the 61.8, and then the negative 1.618, and then your TP2 will be at the 2. And what ends up happening? All your TPs got hit, and you effectively risked 5 pips for 68 pips. Now let's go ahead and look and see. Now this was just on the 5 minute. This was your analysis on the 5 minute. Let's go back to the 4 hour, and let's see if your swing position actually held. Let's see if your swing position actually held. Wait, where was this? Oh, I think it actually reverted price all the way back up. Well, oh well, right? All of your take profits got hit. And yeah, I mean, all of your take profits got hit. And effectively, you won that trade no matter what time frame you would have looked at it from, if you would have used the same concepts that we just looked at for you. I started looking for the form, 30 minute? 30 minutes amazing. It's one of my favorites. 30 minute is one that I was taught. The 2 hour is one that Wyatt put me on. I cannot believe how clean the 2 hour chart is. The 2 hour chart is absolutely amazing. I would suggest everybody that's struggling to look at price on the 1 hour to use the 2 hour. The 2 hour is amazing. One that will look at price as a whole is the 12 hour. Again, credit to Wyatt. The 12 hour just kind of shows how price is moving. All right, if you guys are having trouble looking at how price is moving, effectively, that's how it moves right on the 12 hour. Have another example of, you could consider that reaccumulation and then shooting back up, right? Credit to TradingView. Yeah. So, there's a lot to learn. And this is just the beginning. This doesn't mean that this is going to be, so here we can see that this is probably going to retrace. Maybe right here, maybe to this, bottom mitigation zone. And then what's going to happen? Effectively, what can we consider price to do? Let's say we fib it. Right? Let's say we're trading a little bit more retail. A lot of retail will say 50%, 61.8, 38.2, but they don't know exactly where to put their limits. They're gonna get lost because they're saying like, well, do I think it's rejecting? Do I think maybe? And by the time they get their 7 confirmations, half the move is gone. Right? So if we see this distribution, right, that now it already broke, quote unquote, jumped the creek, right, or broke the ice, what's going to happen here? Now there's bound for a retracement for a last point of supply, right? Now we expect this bound retracement for a last point of supply, and then from there we can re-enter for the sell in this distribution schematic. This makes sense? Seems like a lot of you guys are pretty quiet, but there's 35 people in here. Does this make sense? Are you guys understanding?
Yes.
Yeah.
Because if you guys aren't understanding, I'd rather you ask now, stop me now, so that I can answer your question. You didn't ask. Awesome. So, what time frame do you look for an entry? I look usually on the 5-minute for an entry. So, are you just waiting for price to play back up to half or a bit more than half of the order block? It depends what you are considering an order block. Because up here, this could have been considered an order block, right? However, effectively, you should be looking for the entry. Let me see if I can show you really quickly. So let's go to page 4. Say there's an order block right here, right? And this is a bearish candle. Oh, sorry, this is the last bullish candle. Right, and now price is returning up here. Now that price is returning up here, effectively, you will end up seeing that price will either hit this zone right here, or it will hit the 50%, or a little bit higher than the 50%. Now your stop losses can be right here, or it can be right here. Cool. Now these are your 2 entries, and that's your stop loss for both. Now your take profit would be your fib extensions or whatever other position you decide to take profit on. Okay. Now price is probably going to wick both, right, and then continue back down. That makes sense to you, Lee? Does that make sense to you guys now?
Yeah, bro.
Yes, sir.
Awesome. Now, the rest of the class is basically going to be just questions and answers. If you guys have any questions, I'll answer them for you now. And if not, then I'm probably going to stay out of the market for a little bit, considering that the U.S. dollar stuff that's been going on. I'm not particularly comfortable with how the market's shaping up, but I do think that we can effectively. I think effectively we will get a lot of bearish dollars here. So, well, what I mean by dollars is like euro dollar probably going down, GBP USD probably going down, USD JPY going down, type stuff. I think the DXY may go up. Yeah, I actually do think the DXY may go up, but at the same time, I'm also keeping the fundamentals in mind, because by price action, the DXY will go up, but also by fundamentals, the DXY should stagger in value because of the amount of money that's about to be pumped in. Maybe it'll have no effect on the actual value on the dollar, and it'll continue its rise. That's very possible too. But either way, I'm expecting a 30% rally on stocks this week. Yeah, I'm actually going to look for a sell on GU and EU very soon. I think so. Yeah, I wouldn't look for any buys on AU, NU, stuff like that. I really wouldn't. Maybe they may be scalp buys. They may go up a couple pips, but I really don't think they're gonna absolutely slap. So, yeah, guys. If you guys have any questions, let's go ahead and get them answered right now. If not, we can go ahead and just start analyzing the market as a group off the Zoom, because I have to go eat. Cool.